You know that number you're always hearing about on the news? The one that's usually mentioned with a sense of panic? Yeah. Today we're talking about the U.S. national debt.
Okay, let's just look at this number. As of August 2025, we're talking about almost $37 trillion, and it's climbing. A number that big, it's so massive, it's hard to even wrap your head around.
So is a number that big automatically a catastrophe? Is it as scary as it sounds? The size is just mind-boggling. But what does it really mean for the country, for us? And maybe the biggest question of all is, how much is too much? That's what we're going to dig into today.
All right, first things first. To even begin to understand this, we need a better way to measure it. Think about it. A raw number with that many zeros is almost meaningless by itself. We need some context, some kind of yardstick to make sense of the mountain.
And that's where this comes in, the debt to GDP ratio. It sounds technical, but the idea is actually super simple. It's basically comparing what a country owes to what it earns in a year. Think about it like this. Owing your friend $100 is a totally different situation if you're a billionaire versus if you're, between jobs. The US economy, it's a multi-trillionaire. So, where are we right now? The US debt to GDP ratio is sitting at around 120%. Let that sink in for a second. That means our national debt is actually larger than everything our entire economy produces in a single year.
But, and this is really important, we need some context here. Is 120% a complete catastrophe? Well, believe it or not, we've been here before, or at least somewhere close. To pay for World War II, the debt to GDP ratio shot up to about 106%. The big difference, though, is what happened next. After the war, the country ran surpluses. We actually brought in more than we spent, and that ratio came way, way down. Lately, though, after a big crisis, that debt level just kind of stays high.
Okay, so how in the world did we get here? Well, let me tell you, this isn't some new problem that just popped up, and it's definitely not the fault of just one political party. It's been a long, bipartisan journey.
If you look back over the last 40, 50 years, you see a pretty clear pattern. You've got major tax cuts, huge increases in defense spending, then a brief period of surpluses in the 90s. But then came more tax cuts, a couple of long wars, big economic downturns like the Great Recession, and of course, the massive spending to deal with the COVID-19 pandemic. The point is, decisions made by both Republican and Democratic administrations, whether it was tax policy, war, or crisis response, have all pushed this number higher and higher.
So, if the big scary number itself isn't the entire story, and the debt to GDP ratio has been high before, what's the actual danger? What's the thing we should really be keeping an eye on? What's the tipping point?
Okay, so the real risk isn't just about the size of the debt. It's about something a little more fragile: confidence. See, the U.S. government pays its bills by selling bonds, and for decades, those bonds have been seen as pretty much the safest investment on planet Earth. But what if that changes? What happens if investors, both here and around the world, start looking at the U.S. and thinking, can they really handle their finances?
Now, there's no single magic number where everything falls apart. It's not that simple. But some economists do point to a potential danger zone. They look at a debt to GDP ratio of around 175% as a possible tipping point, a point where the interest payments on the debt get so huge that they just spiral out of control.
And if you want to see what that looks like in the real world, just look at what happened to Greece back in the early 2000s. When its debt shot past that 175% mark, investors totally lost faith. The result? They were forced into these incredibly painful spending cuts on essential services. It led to mass unemployment, a deep economic collapse. It was devastating. Now, to be clear, the U.S. is not Greece, but it's the direction we're heading in that has people worried.
I know. All this talk of trillions of dollars and global investors can feel pretty abstract, right? Like it's happening in a different universe. But this is where we bring it all home. Let's talk about why Washington's balance sheet actually matters to your wallet.
First up, there's this thing called the crowding out effect. Just look at where your tax dollars went in 2024. A huge chunk, 13%, went to just paying interest on the debt. We're talking over $870 billion. That's more than we spent on our entire national defense. And think about this. Every single dollar that goes to paying interest is a dollar that can't be spent on things like fixing roads and bridges, or funding schools, or investing in scientific research.
And second, there's an even more direct impact on you. The interest rate the government pays to borrow money, it basically sets the floor for almost every other loan out there. So when it costs the government more to borrow, you can bet it's going to cost you more to borrow. We're talking higher mortgage rates, more expensive car loans, and bigger credit card interest payments.
And this isn't just theoretical stuff. These costs are very real. Economic models show that even a small jump in the deficit can end up costing the average American household hundreds or even thousands of dollars every single year. That cost shows up either as higher prices for everyday goods, inflation, or as higher payments on your loans.
So, what's the solution? What can we do about this? Well, the answers themselves are actually pretty straightforward to list out. The problem is, they are all politically really difficult to actually do.
When you boil it all down, there are basically 3 levers you can pull. 1. You can cut spending, and the big ticket items there are things like Social Security, Medicare, and defense. 2. You can raise revenue, which means raising taxes on people or companies. Or 3. You can try to grow the economy so fast that it outruns the debt. The catch? Each and every one of those paths comes with some pretty painful trade-offs, and they all require a ton of political courage.
For the time being, the U.S. has a massive advantage. The dollar is the world's reserve currency, which means everyone wants U.S. bonds, keeping our borrowing costs manageable. But that's a special privilege, and as Maya McGuinness, who heads the Committee for a Responsible Federal Budget, puts it, the debt doesn't matter until it does. You just can't take that privileged spot for granted.
So here's the good news, if you can call it that. Pretty much every expert agrees that America still has time to change course. We're not at the crisis point yet. But having that time is its own kind of challenge, because it makes it easier to kick the can down the road. And when the time finally comes to act, every single solution is going to be a tough pill to swallow.
And that really leaves us with this one final crucial thought from an economist who studied these kinds of things. Debt crises tend to happen slowly and then all at once. For years, the problem can seem far away, totally manageable, nothing to worry about, right up until the moment it suddenly and catastrophically isn't.